Okay, welcome to the final part of the lecture. Uh, this part will talk about the we'll talk about central bank's intervention in the foreign exchange market, and we'll talk about uh, the trilemma or the impossible trinity. Okay, so I told you that central banks are a major player in the foreign exchange market in the international monetary system. Uh, and the question is, and they sometimes prefer a strong currency over a weak currency and vice versa, depending on their set of economic priorities, which I told you previously, like inflation, unemployment, interest rate, trade deficit, and economic growth rate. These are the fundamental priorities. Because of this, a central bank may prefer a strong or a weak domestic currency. Now, why? There's a common perception among the people is that a strong domestic currency is always better than a weak domestic currency, especially if you read popular newspaper articles, not the analytical ones. You will see they're often critical uh, of the devaluing currency. But it may not always be the case. A strong local currency may not always be a good thing. Okay, so there are some advantages and some disadvantages of strong domestic currency. For example, what happens when the domestic currency appreciates? Okay, when the domestic currency appreciates, imported goods and services become cheaper. Imported raw materials become cheaper. So, a strong domestic currency can reduce the production cost. And of course, it reduces the price of import. As a result, inflationary pressure may decline. Okay, it may result in low inflation, which is a good thing. Okay, one more thing is strong currency sometimes attract foreign capital. Okay, how? Because when the domestic currency becomes strong, assets denominated in domestic currency, they become more attractive because strong currencies, people want to invest in strong currencies, assets denominated in strong currencies. Okay, so that they gain in value in the future. That's why there is an increase in foreign capital. Okay, on the other hand, a strong domestic currency means exports become less competitive because there are they face strong competition from other importers, foreign importers, other exporters, sorry, other exporters, okay, in the foreign countries. So which may result in unemployment and which can reduce foreign investment at home. Okay, so please don't be confused. A strong domestic currency, because of strong domestic currency, foreign investors, if they want to invest in your country, they have to purchase the domestic currency. When the value of domestic currency is high, the foreign investors lose interest in investing in your country. On the other hand, if your currency gets strong, assets denominated by your domestic currency, they become attractive among foreign investors. So that may increase capital inflow. Okay, so there is no one solution, or there's always a trade-off between strong domestic currency and weak domestic currency. Okay, there is no win-win situation. Always Whenever the currency value increases or decreases, some people, there is one side of the market which is benefited, and there is another side of the market which loses from that change. That is why countries and business organizations, multinational corporations, financial institutions, they always prefer stable exchange rate. Okay. uh, Strong currencies, as I said, has some advantages and good and some dark sides. So appreciation, neither appreciation nor depreciation is always a good thing or a bad thing. There are always winners and losers of of a currency price movement. That's why stable currency prices are preferred by everyone. Okay, so uh, governments, as I said, they can prefer overvalued or undervalued currencies depending on their goals: growth, employment, and stable prices. These are the so-called macroeconomic goals. Now, let us consider the Chinese case. At the end of uh, chapter 2 of your textbook, there is a mini case of China. You can read it. That's a very nice case. I'll actually recommend you to read that. So now, for the timing, let's discuss this Chinese case. Between 1995 and 2005, China fixed its exchange rate at 8.28 yuan per US dollar. Okay. According to some estimates, it was undervalued against the US dollar by 20 to 30%. So, in other words, if the Chinese government let the Chinese yuan to move freely in the market, if the value of Chinese yuan was determined by the demand and supply of Chinese yuan against the US dollar, then its value could have been increased. That was according to many estimates. Okay. The Chinese yuan was undervalued by 20 to 30%. So USA and the rest of the world actually complained that this gives yuan an unfair advantage in the export market. Okay. In 2005, the US Senate, they voted for the imposition of tariff on Chinese imports of 27.5% because of this fact. Like they believed that Chinese yuan was undervalued, which gave an unfair advantage in the export market. Okay, now the question is, why was China resisting the clamor of yuan revaluation? So USA and the rest of the world, they wanted China to revaluate or increase the value of Chinese yuan, but China didn't. China was reluctant to do that at that time. Why? The second question was the Chinese strategy risk-free? Okay. So to answer the first question, why was China resisting? Why was China reluctant to revaluate the value of Chinese yuan? First of all, it wanted to maintain a stable price level. Okay. The moment you let the currency price to move, there is a pressure, inflationary or deflationary pressure, the domestic currency. So China wanted to avoid that. Okay. And they wanted to maintain low export prices. Otherwise, Chinese production and employment would be affected because China was the major exporter. I mean, till today, they are the major exporter of the world. They are called the manufacturing hub of the world. So if the Chinese yuan evaluates, appreciates, the Chinese exporters will lose competitive edge in the market, and that could have affected Chinese employment. This is why Chinese government, did not want to increase, revaluate the Chinese yuan. Now, was it risk free? No, it was not risk free. Okay? There was some dark side. What? Undervalued currency attracts foreign investment. Okay. Now again, don't get confused. Assets denominated in undervalued currencies are not attractive. Okay. But undervalued currency attracts foreign investment. So people, the foreigners, they become interested to establish plants in a country when their currency is undervalued because it is relatively cheaper to invest in that country. So what happened? If undervalued currency attracts foreign investment, this keeps an upward pressure of the value of yuan. So it is difficult to keep the value of yuan at a low level. In order to maintain a fixed exchange rate, China had to sell yuan to buy all the foreign currency inflows. And for that, it was costly. It was simply costly. Okay. But still, when the Chinese government wanted to keep the value of yuan fixed, keep at a low level, lower than market level, and it had to buy, it was buying US dollar and all other foreign currencies using Chinese, it was selling Chinese yuan to buy up all the foreign currencies. It increased the supply of Chinese yuan in the market, which created an inflationary pressure on the economy. So the Chinese strategy was not risk-free. On the one hand, it was costly to maintain an undervalued price of Chinese yuan. On the other hand, in order to maintain that low value, it had to sell Chinese yuan, which increased inflationary pressure on the economy. Okay. So there was upside. Upside was that by maintaining an undervalued Chinese yuan, they gained a competitive advantage in the export market. The dark side was that it created an inflationary pressure on the economy. So this is an example of central bank's intervention, which most of the cases, which has an upside and a dark side, in other words, which has a trade-off. Okay. Now, what are the mechanisms of government intervention? It is simple. Okay. Purchase and sale of foreign currency by the central bank. For example, if the Fed, which is the central bank of the US, if Fed wants to raise the value of dollar against euro, it will buy dollars with euros. If the European Central Bank wants to reduce the value of euro, it will sell euros in the foreign exchange market. Okay. So this is how central banks intervene in a free floating exchange rate mechanism. And they play an important role in order to keep the value of their domestic currency at a desired level. Okay. And sometimes that is why sometimes we call that it is very difficult to find a country which adopts a pure or free floating exchange rate mechanism. Rather than most of the time, we see a managed float where central banks actively participate in a free floating system, in a floating exchange rate mechanism, either by purchasing or selling its domestic currency, okay, in large quantities, which affects the demand and supply side. Okay, excellent.